All right. Welcome everybody to our annual session here today. I see everyone getting admitted. I know Zoom and every other platform takes just a second to let everybody in, so we'll give you just a moment here. Really excited to have everyone join us today, carve some time out of their busy Januaries, I know, for what is now, I think, our eighth or ninth annual session that we've done. We collectively at Succession Resource Group work really hard to aggregate the data from the prior year. We tend to do it twice a year. We've done that for a couple of years now. In January, looking back at the prior year, give you our predictions like we plan to do today for 2023. We do it again usually in July, looking at the first half of the year. So stay tuned for our mid-year update just to help us collectively keep our fingers on the pulse of what's happening out there. So our topic today, there's a lot of things that we can talk about that happened in the prior year, especially with a year like 2022 and then 2020 before that. I mean, we've had an interesting last couple of years, but this year in particular, looking forward to 2023, we're going to focus on mergers and acquisitions, succession planning for sure, which is the topic we always talk about every year, and we publish it, we write about it periodically, but also covering equity predictions, because while we do help folks value, buy, and sell their businesses, I mean, it's a core tenet of a company called Succession Resource Group. There's also a lot of work that we do, like one of our panelists, Nicole Fry, will talk about here today, that is a little bit further from the exit door of the actual transaction. It's about setting the organization up properly. So it's a little bit broader subject like we covered last year. For those of you that had the opportunity to join us, real quick background, I don't want to spend a lot of time on this because we've got a lot of great content, great sponsors to thank. So I do want to get to that, but for those of you that were trusting enough to register for our session today and not be familiar with Succession Resource Group, lots of friendly names, faces that I know, but I do have a few folks who I don't recognize. So real quick background here, Succession Resource Group, we're a consulting organization based in Portland, Oregon. But at this point, post-pandemic, I think our 17, 18 team members here are scattered around the country, still primarily, I think half of us are in the Portland market where we started the company, but we work with advisors, accountants, agents nationwide, just within the US, but it's kind of our niche market. We tell folks we know a lot about a little. You are in a nuanced market, and we deal with a nuanced subject, mergers and acquisitions. So you can see on the right-hand side, when I say mergers and acquisitions and succession planning, the things that we generally focus on, which cover valuation for sure. It is kind of your gateway drug to a lot of the other stuff that we do. It's a good entryway point, and Kristen will talk more about some of the reasons that folks do valuations, what to expect in predictions for 2023 around that subject. But we also do a lot of work on what I would just generically call improving the business, organizational planning, strategic planning, protecting the business and the equity, growth, certainly, be that mergers or acquisitions. I'd also put that under the category of best practices to make the business more valuable, helps it grow a little more indirectly. And then the exit side, where we work on sell side representation for advisors wanting to exit, needing help finding a buyer, negotiating a deal, succession planning, private transactions where we're more of a facilitator, and mergers. That is the scope of what we do. So we really, we eat, sleep, and breathe this stuff, and it is the only thing that we do. And we only do it for folks like you. So joining me here today, I have three amazing, I'll say panelists, but what I would tell you, disclaimer, these are not professional, public speakers. I mean, they do it just like I do quite a bit throughout the year, but these are folks who are in the trenches with you working on these projects. So from left to right, we've got Nicole Fry. She's been here quite a while and spends a lot of her, well, I say a lot, basically all of her time, if she's not presenting or writing, curating data to share with you all, on working with her team to help advisors like yourself establish their organizational best practices and plans. So it's entity formation, which sounds simple. As she unpacks that a little bit here today, I think you'll find it can be simple. It can also be a little bit more interesting and complex. A lot on compensation plan design, employment contracts, so your internal best practices. And then moving to the right, we've got Kristen Grau, CPA, CVA. Her focus is on valuation and on the sell side advocacy stuff. So a lot of insights that she'll share here in the middle part of the presentation on, again, what's been happening out there, best practices, value drivers and detractors, current multiples, which is stuff we like to bring back to you each and every year. And then Parker will close us out and get us to the interactive part of the presentation with the Q&A. He's going to focus on the mergers and acquisitions, like the actual transactions, how these things are financed, how they're taxed. Again, interesting and noteworthy changes and trends there. So as we go through and we talk about this is going to be, lots of insights and predictions, and it will be amazing. Don't get me wrong, but it is also going to be pretty heavily data driven. And if you're going to see a presentation with a lot of data in it, you should know the source. So this is, I would say, generally self-sourced, but it isn't just our data, which you're going to look at here today in the data that we do share. Comes from hundreds of valuations that we have done, but it also comes from more than 150 actual transactions from deals that Succession Resource Group worked on, but you also have data contributed from Live Oak Bank, PPC Loan, Wealth Advisor Financing, some of the industry's biggest, best, most prominent lenders. So presumably there are transactions in here from all of the folks who do what we do, the various brokers, M&A, succession consultants. So bottom line, pretty good cross-section of the industry and what's happening out there. We will get technical, don't get me wrong. And I think a lot of the technical terms you'll hear here will be terms you're probably familiar with. But if you're not, and you hear us reference, EBOC or EBITDA or revenue multiples, any of the definitions that you see here, you can either A, take a quick photo or screenshot. B, you can also just drop your question into the chat, and our moderators will put that definition in there for you in case you need it. So again, just good housekeeping. I think most of the stuff you're probably familiar with or could find on Google, but if you can't, let us know. We will help you. Which takes me to one of our most important slides here, and that is thanking our sponsors. Doing these webinars on a biannual basis, but this big one every January takes a lot of time, takes a lot of effort from our team, both the presenters and all the amazing people that you don't see behind the scenes that help pull all this stuff together. We couldn't do it without our sponsors. Certainly, we couldn't do it as good as we do it now without our sponsors. So to touch on a few of them, some natural ones here, and firms, frankly, that we have experience with. You've got Gateway Financial Partners, the Ameriflex Group. I mean, two pretty cool RIA OSJs that make good sponsors here because they are not ignorant to succession planning, the importance of mergers and acquisitions, and provide a lot of support around this subject. So they can be great resources if you're looking for, sort of supported independence. They can be great folks to reach out to and talk to. Firms that, we work with on the M&A side on transactions, helping them with their advisors. Of course, we've got Live Oak Bank, a great sponsor, great partner. They've been pretty active in this space since they committed to it in 2013 or 14. So, James Hughes over there, John Turner, formerly Mike McGinley, who, we all have affection for, know and love. So really, really good team over there, great resources. And of course, AssetMark, who is here today under the banner of a sponsor. But I would also tell you, we work closely with them. They work closely with us to help their advisors, again, with succession planning. Frankly, I think they do this almost indirectly, helping advisors build more valuable businesses, more scalable businesses. So they've been a great resource partner of ours for years. They are also kind enough to help sponsor and make today possible. So with that, Matt, since Matt was kind enough to join us here from AssetMark, I figured I'd go ahead and let him say a few words, because while I can say lots of nice things about AssetMark, he's going to know their internal workings and dynamics better than I will. Matt, all yours.
Yeah, David, thank you so much. Appreciate you and the team having us on board, without a doubt. I'd like to spend a little bit of time. I could certainly sit up here and give an AssetMark commercial. I think hopefully a lot of the advisors and attendees know who AssetMark is. We're effectively a platform provider. We provide kind of middle and back office solutions for advisors and RIAs throughout the industry to help them drive scale and efficiency within their firm. Some of the things that we do on an annual basis is we actually look at the marketplace much like you do. We try to provide insights and research, and I think that's kind of the core cornerstone of our discussion today. So I'd rather spend time on that versus kind of the AssetMark commercial, and maybe provide some food for thought to the attendees here to kind of think about their business maybe a little bit differently than what they have previously. So when we went out and we surveyed over our 700 individual financial advisors, and they kind of fell into three major categories. One being outsourcers that work with AssetMark, those non-AssetMark outsourcers, so using other solutions, and non-outsourcers. And of those 700 advisors, what we found was those advisors that were outsourcing. And in fact, it ends up being like a tipping point. So the more you start to outsource in your business, and that could be to technology solutions, it could be to firms like AssetMark, it could be to other investment management capabilities. The more you start to outsource in your business, the more you start to scale and drive efficiencies. In fact, we saw the tipping point in our data to be about 70%. So if you outsource about 70% of your total assets, you start to see exponential benefits in terms of what outsourcing can do. Now, that being said, what we found in our study data was 91% of the advisors reported accelerated growth in total assets within their firm. And that kind of bleeds into the next two elements, is they're able to save 1 day a week worth of time. Now, a lot of advisors could spend that time in business development efforts and to be able to drive more growth within their organizations. Other advisors that have more of a lifestyle practice want to spend their time in other ways. Maybe it's spending time with their family or doing other things that they love. Nevertheless, if you're outsourcing a significant amount of your total business, you're able to spend more time in other ways or drive deeper engagement with your existing clients. The other thing that we saw was 8 out of 10 advisors reported lower operating expenses within their firm. So they're able to drive scale, they're able to drive more efficiency. Largely those lower operating expenses were the result of lower headcount because they're not having to hire more people, CFA, somebody to run model portfolios, somebody to handle compliance and everything else, because they're outsourcing a lot of those things within their business. So again, drive more scale, more growth, more efficiency. And then the last slide I'll leave you with, and I'll turn it back over to you, David, is you start to look at kind of cornerstone components of what outsourcing can do to make an impact on your business. So 98% of advisors cited greater oversight of portfolios, improved investment performance for client accounts, a broader range of investment products than if they were to basically manage assets themselves. 99% said that they had better business efficiency and growth through what I touched on earlier, lower operating costs, higher growth in total assets, so on and so forth. The other one, certainly germane to this conversation, is they also saw higher business valuation within their firm because effectively it's more scalable, it's more easily transferable to another advisor, and it's a repeatable process. So definitely, certainly germane to our conversation today. 94% found a better client relationships in some of the bullet points there. The last one that we surveyed, the last kind of point that I really want to make is 97% of advisors actually had a better career satisfaction and better personal life satisfaction rate because of outsourcing. So they didn't have the stress of having to manage all of those middle and back office components in their business. They had more free time to be able to spend what they wanted to do and to be able to drive better efficiencies and growth within their firm. To me, that sounds like a win-win-win across the board. So if you're not thinking about outsourcing today, I would certainly encourage you to do that. So that's my public service message for today. Appreciate the time, appreciate you having me on, and I'll turn it back to you, David.
Yeah, and I appreciate it, Matt. And again, to your point on the higher business valuation, it's germane to our conversation today, obviously, on understanding what valuation looks like in today's market, what's been happening out there. And I mean, it really is so important to think about creating scale. How do we hand the business off to the next generation someday? Have repeatable processes, and I suspect these are all things that AssetMark would help solve for.
Absolutely.
So in terms of our agenda here, we're going to kick things off with Nicole talking about employment and entity trends, which will lead naturally then into some of the improvement best practices, current multiples we're observing in the industry that Kristen will hit on. And then, like I mentioned earlier, Parker will bring us home with the mergers and acquisition data deal structuring trends. And then we'll get to the panel discussion. We've got a handful of questions that were sent in ahead of time. We also encourage you, there's a Q&A panel in the session here today that we will be keeping an eye on. If it's a simple question, we'll have our moderators just respond to you, live as we progress. Otherwise, we'll save your questions for the end and we'll make sure we get to them. So without further ado, Nicole, all yours.
Thanks so much, Dave. It's always a ton of fun to join my team members here for the annual webinar. As David mentioned, I will start us off on the employment and entity trends. And most of you might be wondering, well, how does that relate to the M&A transactions that we will discuss today? And my answer is, well, quite a great deal. The M&A transactions are typically in large part based on companies' efforts to consolidate or to expand. And what that means is the companies don't just integrate a new book of business, but oftentimes they also integrate another firm's operations, or they include equity transfers in those transactions. So what that means is the companies have to make sure that the human capital is set up in a way that can absorb another book of business, and that your organizational framework is set up in a way that can allow for equity transfers. So without further ado, I want to share some of those employment trends with you, because ultimately that is a huge part of those M&A transactions. And just to cover real quick what employers saw in 2022, there are, again, continuing recruiting and retention efforts of companies. It doesn't seem to be surprising. Ultimately, that's one of the top priorities of most firms, if not all. However, what is somewhat unique is that nowadays those efforts have become increasingly more difficult due to the pandemic and the following Great Resignation. It is more difficult to fill, especially highly qualified positions, so that many companies are looking into diversifying their employment resources, tactics, and tools. And that means they're focusing on setting up compensation plans that include fixed and bonus compensation. And that is not just for the non-licensed employees, that includes licensed employees as well. They are also creating salary bands, and those salary bands are meant to communicate what salary increases are. They're a great way for employees to predict how they can achieve salary increases. And those salary bands are supposed to be role specific. So for firms, that's a great tool to also make sure that employees' pay raises are tied to certain performance goals. And that same goal is achieved by having bonus options offered to employees that are tied to specific job roles, as well as to the goals associated with their job roles. So that's what employers are focusing a lot on, to make sure that the compensation achieves the desired results. They are also including more and more long-term incentive plans that are supposed to replace the more traditional model. For example, employees having the ability to retain equity in certain client groups. So that is going away slowly, as I see it working with clients. Instead, firms are implementing tools like phantom equity sharing plans or true equity sharing plans with their employees. Another trend is that employers are seeking to specialize the employee job roles, especially as companies grow. The result of that is higher scalability. Employees tend to focus on just a smaller group of duties at that point, so that they can gain greater knowledge and ultimately become more efficient and effective. And last but not least, there is a greater focus on risk mitigation. So what that means is employers are implementing employment agreements with restrictive covenants. That's those non-solicitation, no-serve clauses that you might be familiar with. So they're implementing that not just with licensed employees, but with non-licensed employees as well. So when we take a look at the staffing levels for smaller companies, we notice that there are not a whole lot of employees needed. The numbers you see here are based on full-time equivalents. But as firms increase their production and they're increasing their client base, there are higher staffing levels needed. So this is where these recruiting efforts come in. Ideally, you would take that step proactively, meaning you would hire employees before they're actually needed, so you have enough time to train them. The recruiting efforts are also reflected in the recent salary numbers. As I mentioned, highly qualified people are highly sought after. So lead advisors, for example, experienced a greater bump in pay. Junior advisors, we saw a slight increase. For administrative people, they pretty much stayed the same, but that is because the potential pool of candidates is a lot larger to choose from. But lead advisors are more difficult to find. There's a little bit of a delay. All right, here we go. The salary is, as I mentioned earlier, often based on salary bands. Employers are implementing those bands in order to communicate to staff members what they need to be doing in order to get salary increases and what those salary levels are. To set up salary bands, some companies use statistics such as these, where you utilize the bottom quartile for the bottom end of your salary range, and then the top quartile for the upper end of that range. When using statistics, I always tell clients, please take them with a grain of salt. We don't know what type of firms are submitting those statistics. It might not be representative of yours. You might be offering more work-life balance, or maybe you have quite a bit of bonus compensation that you are offering, or perks and other benefits. So it will be good when you look at these statistics to also take into consideration everything else that your firm is offering. For salary and bonus compensation, it's a little bit of a surprise to see that licensed employees and non-licensed employees are pretty close in what they're receiving here. But as I mentioned, the trend is to provide more fixed compensation to employees across the board, and that includes licensed people as well. It provides certainty to your licensed employees, and for firms, it's a way to also communicate that you expect them to contribute to the company in terms that could exceed their general production. Maybe they're training other staff members, or they're helping you implement a CRM system or run a branch office. So that's what those salaries are meant to be for. We want to communicate their other duties that they're supposed to perform. And then the bonus compensation is implemented across the board as well. And again, everything here is tailored to someone's specific job role. So even though the percentages here are very similar, the actual goal and the bonus tied to that goal could look quite a bit different.
A real quick question while you're on that subject matter, Nicole. I know, I think most of you listening probably know, historically, the trend has been like revenue-based, GDC-based compensation. I hate to say it, but it's kind of simple and it can't not work. It doesn't seem like that's been the trend as of late. So, as you sit in the seat you sit in working with clients, pros and cons of the salary and bonus versus maybe GDC-based comp, and what do you think for 2023? More or less of one or the other?
The GDC-based comp might still work for certain business models. There are firms that are actually using that very successfully, but it's not a good fit for some firms. So first of all, if you're broker-dealer affiliated, we always have to be careful how we're structuring things, especially if you're planning on paying your employees from an entity. So there have to be other compensation models that achieve similar results. And then many firms also want their employees to start thinking about the company as a whole. So not just on their individual production, and there have to be incentive tools, and those come in terms of, or in the form of compensation that would encourage employees to look at other great performance indicators in the firm. So it depends on what your business model is and how you would like to pay your employees and what that relationship looks like. But there are different options there for sure. So for 2023, we predict that the same trends will continue and will be built out more. Firms will engage in strategic organizational planning, meaning they're actually trying to plan out what the firm will look like in maybe 10, 15, or 20 years. What kind of infrastructure do they need? And based on the different departments, they will create hierarchies that serve as the foundation for career paths so that they can actually map out what types of roles they need, and for their employees, how they can grow from one role into another role within the company. And then compensation will be tied to those career paths. And the last item here is equally important. Employers will also make sure that they mitigate their risk. So those non-solicitation, no-serve, and confidentiality agreements will be implemented company-wide. On the entity side, some of the changes that we saw in 2022 pertain to the extent advisors are utilizing the entity. So in the past, entities were more used for organizational purposes, expense management, for example. And a lot of advisors are now noticing that they can accelerate or leverage the usage of that entity by giving it value. And I know there's a lot to that, so I'll get to that later. So entities can actually have value so that you can use them for equity sharing purposes or for purposes of merging with other companies. And so they're looking into not just short-term plans, but also long-term plans. What do they want to use this entity in the long run for? And this is why the LLC, as we listed here, has gained in popularity, because the LLC provides a lot of flexibility, which is important in the long run as you develop your business. Also on the rise are entity structures that are a little bit more complex. So I will share some more information on a multi-tier entity structure here in a little bit. If we're looking at entity structures by firm size, this is not a great surprise. Actually, this is reflective of businesses, not just in this industry, but in all kinds of industries. As you start out a business, you would typically start as a sole proprietor. And then as your business grows in complexity, there's more liability exposure. That's when you start looking into setting up more formal entity structures like an LLC or an S Corp or a C Corp. Looking at entity structures by firm type, which should pop up here in a second.
And while it does that, Nicole, quick question. Is there a size where it makes sense to use an entity versus, too small, probably not too big, but what are your thoughts on that?
Coming from a legal background, I will always tell you it's beneficial to start off with an entity right away. It never hurts. However, we have to do a cost-benefit analysis. Obviously, there is some administrative effort required in order to set that up, making sure you're maintaining that with the state. If you're all by yourself, an LLC is not a big deal to maintain. However, if you have an S Corp, now you're looking into additional tax filing requirements. So it depends on the size of your business and do you actually have a benefit from that entity. From a legal standpoint, probably yes, for liability purposes, but we have to also take in consideration the extra work. So looking at the entity structures by firm type for RA related people here in the audience, that is probably one of the first steps that you're considering is setting up an entity that will have that will serve as the registered investment advisory firm. So your clients will contract with that entity. For broker-dealer affiliated business owners, that's not always the first step because there are a lot of questions out there with respect to whether or not this raises compliance issues or maybe even IRS audit issues. So there are a lot of questions that need to be worked out. However, the answer is you can still set up an entity and you can leverage it to its maximum potential depending on what your business goals are. So it can be a really great tool or resource for you as you build your business. And I apologize for the delay. There's always a little time lag in pulling up the next slide. I mentioned that the LLC has gained in popularity, and that's due to its flexibility. An LLC allows you to structure profits in a way that doesn't necessarily have to align with an owner's ownership percentage. You can also regulate how you cast votes, how the entity is managed. You can easily integrate other owners into this company. For example, owners can contribute their book or their goodwill in exchange for ownership without having an immediate tax impact. The S Corp is not quite like that, so there are some restrictions here. And so for folks who would like to engage in mergers, thinking about recruiting other people in exchange for their book, the LLC is a pretty good tool for that. Now, I talked a little bit about the purpose of an entity, that a lot of advisors are looking at using an entity for equity sharing purposes. Those advisors would consider contributing their book of business or their goodwill to the entity, so the entity actually holds the goodwill. And that means the entity would have the business value. It sounds very fancy, but there's no actual handoff of the clients. It's a simple corporate resolution that would be necessary. So just a little bit of paperwork, and then the entity can hold the value. If you're only setting one up to utilize it for operational purposes, you would only contribute cash most likely. So in that instance, the total business value or the bulk of the business value is owned by you personally. Last but not least, I did talk about the multi-tier entity structure as one of the more complex structures we see. The way this works is advisors would set up an LLC that holds the total business value, all of the revenue, most of the expenses or all of the expenses, it depends, and the business operations. And on the LLC level is where the ownership division occurs. However, the owners do not own their interest personally. Instead, they're setting up individual S corporations so that the S corporation would be considered the owner of that LLC. And then what happens is any profits coming out of the LLC would flow to the S Corp, where owners would pay themselves a reasonable salary, most likely. Maybe there are still some expenses in there that they don't want to hold in the LLC. And then the rest flows out at more favorable tax rates to them in the form of profits. So this kind of structure provides the flexibility that they're looking for on the LLC level for mergers and equity sharing plan and purposes. And it still preserves the tax savings component on that second tier where the S Corps reside. So, and with that, I'll give it back to you, David. I'm most likely to have Kristen share some more information on the valuation trends.
Yeah, no, appreciate that, and perfect segue here now, obviously, with you laying the foundation, literally and figuratively, for a lot of these businesses. Now, Kristen can go into what's happening with valuations, the multiples that we all love to hear about, where we're heading directionally. So, Kristen, all yours.
Thanks. The last couple of years have been a doozy. Over the last few years, we've seen firms industry-wide navigate an unknown work environment and increase flexibility. But our top valuation observations for 2022 are as follows. And again, a little bit of delay here.
For it.
What is measured improves. Common saying, but in 2022, we found that to be exactly the case. Approximately 80% of the firms that we valued annually saw above average multiples. These firms had a higher valuation multiple of approximately 4.8% higher than those that were non-annual valuation candidates. This percentage was also consistent with firms who hired a business coach. One benefit of COVID was also the forced nature of a virtual work environment, which meant many firms had to shift in the wake of the pandemic and have since stayed in a more virtual work environment. This has allowed for a new and diverse workforce that wasn't previously available, and a shift in the dynamics related to advisor and client communication, including location, frequency, and methodology. We also saw that firms with at least 30% of clients being part of a multi-generational family group received a 5.9% higher value than their counterparts with less than 30% of multi-generational clients. In essence, those who are focusing on the multiple generational family groups created that client longevity within their practice. We also saw a lot of firms planning for the future and using the valuation as a means to create transparency and consistency around their initiatives. A lot in regards to what Nicole was saying earlier in regards to equity sharing and employment compensation strategies. Before we dive into the ins and outs of what impacts evaluation, let's discuss the most common use cases for evaluation. I think that there's a really common misconception that the only reason to get a valuation is because you're going to be selling. In fact, valuations can be done for many different reasons, with a summary of some of the more prevalent reasons shown here. In 2022, our team saw a large influx in mergers and teamings, structures with over 10% of our valuations being related to parties looking to merge firms to create a bigger enterprise. Succession and entity sharing also remains strong, as well as benchmarking, as a lot of advisors were acknowledging that one way to attract and retain talent is by keeping them financially invested and providing equity in the business. In addition to several reasons to value a practice, there are also many value drivers. We'll discuss some of the core drivers that impact value next. Recurring revenue is a common one. Not only does recurring revenue aid in a positive growth rate, but it's more sought after due to its predictability. Larger firms often tend to be more selective about the types of clients joining the practice, including client minimums, and as a result, often offload clients that are no longer a fit to their business model by selling them or segmenting them to junior advisors in an effort to cross-train. We also see client age being another value driver. Here you can see that the average age of clients is approximately 11 to 15 years below the age of RMDs, as the Secure 2.0 Act once again delayed the RMD age to 73. As practices get larger, the average age of the clients decrease slightly. This is likely a result of client acquisitions, increased professionals, usually younger, doing business development, client referrals, and a focus on multi-generational client relationships. Tagging on to the multi-generational client groups, we see approximately a quarter of practices that have multi-generational planning in place. This is usually a good way to ensure the longevity of your firm with an aging client base and ensure assets are maintained. Another core value builder is growth. Employee growth, client growth, net flows, and revenue growth are all likely key drivers to understanding the long-term success or failure of a firm. As we are all intimately aware, the markets have been less than desirable. But valuation is not about the short term, but rather the long-term sustainable projections of the firm that is rooted in the historical performance. Valuations are not about yesterday, last month, last quarter, or even last year. Although, if we look at last year, we can see that firms didn't grow as successfully as in the past 3 or 5 years. This is, in our opinion, a market correction to the growth that we saw in 2020 and 2021. However, if you're looking at the 3-year growth rate, nearly every practice is in the double digits, and the 5-year growth rates are well into the double digit with growth rates. This is one of the key reasons why we believe that practices are still undervalued in this industry. We are seeing some inexperienced acquirers who are taking a short-term approach to the firm and valuing solely based on the T12 figures. We believe that this is an erroneous application to valuation and is no different than a seller trying to receive top value for a recent influx in revenue that hasn't been fully enforced by historical performance. Reviewing revenue over a 5 or 10-year period is key to reducing the peaks and valleys and providing a more accurate and reliable growth rate into the future. Following the analysis of some of these core values, we arrive at multiples. Multiples are one of the banes of my existence. It's a very tricky topic. And while the topic is discussed regularly amongst advisors and firms, often citing, I knew a friend that got 3 times multiple or 10 times multiple. So often people don't understand the how or the why behind how multiples are used. Multiples should be used as a guide, not the end all be all. It's important to understand that they are an output, not an input, and normalizations and exclusions of expenses or revenue may impact how and why practices values shift. In 2022, for the first time in a long time, we saw that the recurring revenue did fall slightly from 2.83 times to 2.8 times. We believe that this is largely related to the market decline and conversations around a potential recession. We anticipate that this multiple will increase into the second and third quarters of 2023. We also saw a decrease in regards to the non-recurring or transactional revenue multiple of 0.73 this year. And that's really just because firms aren't willing to pay as much for one-time revenue sources and are really focusing on that recurring revenue stream. This year, we also provided you with a gross revenue multiple that we hadn't historically provided in the past. The goal or the focus behind this gross revenue multiple is really just trying to give you a sense in terms of how this multiple looks if you combine both revenue sources, recurring and transactional, and are looking at it more from an earnings-based approach rather than a revenue-based approach. I also think it's important in regards to talking about the misconceptions of what a multiple is indicating that the multiples that we cited on the previous slide are averages. Not all practices are created equal. And this means that some firms are going to sell for less than the average, and some firms are going to sell more than the average. It seems like a common or easy concept, but when you're talking to sellers or buyers, all they're focused on is the revenue or multiple or EBOT or EBITDA multiple that they have in mind. And it's really important to understand that, again, those are just averages and guidelines that should be used to illustrate certain things, but truly evaluation is going to be your best methodology to understanding what the value of your firm actually is. The table here is really designed to show just that some practices, are falling below the industry average, and that could be for a wide variety of reasons. It could be because they have a less desirable practice. Maybe they have lower revenue per client. Maybe they have older clients. But it could also be based on how they structured the terms of the deal. Maybe they wanted more aggressive tax treatment, or perhaps they wanted an all-cash deal, which Parker will talk about here shortly. As you start to increase the risk to the buyer, generally speaking, we find that the multiples are decreased to offset that risk. And the same would be true for the optimized practices, those that are receiving above average multiples.
Can you elaborate real quick, Kristen, if there is a quick version of it on clawbacks? And those are terms that we know, obviously, because they come up in deals and valuations a lot, but what do you mean when you say clawback?
Yeah, so a clawback, and Parker will discuss this a little bit more, but a clawback is essentially an adjustment to the purchase price if an amount is held back. So if we look at a common deal structure, there's going to be a percentage paid up front and then a percentage held back. And that percentage held back will be defined by a clawback. So percentage of revenue retained or assets under management retained. And based on if those metrics are hit or not, that may adjust the final down payment. Okay. I also think, again, it's important to understand that valuations can vary based on the location of your practice. So on this particular slide, Nev indicated revenue multiples by region. For example, valuations in the Midwest averaged a multiple of 2.58 times. We believe this is largely due to the client service model, with most firms in the Midwest staying with a predominantly in-person client service model, and a lot of the Midwest being a little bit more rural, where a local servicing advisor and cultural fit is needed in order to ensure the success of the firm, therefore reducing the buyer pool. Add into this the type of the firm and even the size of the broker dealer, custodian, or TAMP being used, and these multiples can decrease or increase further. Firms that are not bound by geographical location tend to have higher demand multiples, tend to have higher demand and therefore higher multiples. This has allowed for out-of-state purchases to receive an average recurring revenue multiple of 2.96 times. But revenue multiples are not always the best methodology. Firms in excess of 2.3 million in annual revenue, multi-owner firms, or teams with complex compensation structures may be better suited with an earnings-based multiple like EBITDA. EBITDA multiples range from 5 to 12 times earnings, with different factors such as client age, team, and tenure indirectly impacting the growth of the firm and projected future cash flows. The importance in an earnings methodology is to understand that exclusions and or normalizations that are applied can have that are applied, such as an increase to owner compensation if it's too low, which would consequently reduce the earnings. So again, a lot of times there's a lot of noise in the industry where people talk about a 12 times multiple being applied. If you don't know what that number, that 12 times is based on, you can get a vastly different result. So regardless of whether your firm uses a revenue multiple or an earnings multiple, again, it's important to remember that the multiple is a product or output of the value and can be heavily influenced by the underlying practice dynamics. Next, we're going to discuss the top 5 factors that we believe will impact valuations in 2023. Maybe. Though we anticipate multiples to hold steady or increase, the anticipated recession and increased interest rates may impact overall firm sales prices, given that buyers are looking for an immediate return on their investment net of debt service on day one. We do anticipate that the evolution of the fee structure model will start to be more prevalent with a retainer-based model over an AUM-based model, thus allowing clients to maintain revenue figures more consistently despite of the market. Due to consolidation, we also anticipate increased mergers, which will allow firms to increase their footprint and service model with more bandwidth and lower overall cost structure. We anticipate that teams will continue to grow and refresh their compensation models away from grid-based compensation to improve the value of their firms as they increase their equity sharing incentive plans. We also believe that the remote and hybrid service models will continue to increase, with more meetings being done virtually. Next up is Gamby Parker.
All right. Thanks so much, Kristen. Now I'll give an overview of 2022 transactions, as well as what we see on the horizon for business combinations and transitions. So how did buyers fare in 2022? Well, of course, they're shifting to seller financing based on current interest rates. Market cyclicality has influenced the conversation on purchase price. However, business value is a lagging indicator with a longer term basis, as Kristen has already mentioned. We did see a modest resurgence of earnout purchases driven by a desire to naturally protect buyers while also rewarding sellers for growth. After all, who would have expected market returns after a pandemic and economic lockdowns? One tidbit about earnouts: when sellers ask for a minimum total payout, it's not uncommon to also therefore set a maximum total payout. So do keep that in mind during those discussions. Finally, competition amongst buyers is still strong, leading some firms to pursue additional targets outside their traditional business line. For instance, financial advisory firms, purchasing tax practices. And now a few timely and interesting deal statistics to share with you all. All right. So with out-of-state buyers, as we've already touched on, about 1 in 4 deals were contemplated or completed by an out-of-state buyer. This has grown since 2020, and of course, we expect to continue growing. Further to that end, buyer to seller ratio in 2022 was 81-1. While that number does seem quite staggering, the number of close fits for any prospective sale is really closer to something like 5 or 10, if that. Deals that we saw with clawbacks, it was briefly described earlier, 45%, so about half. But to take that a click lower, we'll take a look at the mechanism that was used. Around half were revenue-based, 35% were AUM or asset flows-based, and the remainder, 15%, was client or household-based. The average threshold for that trigger of the adjustment held at 90%, so in line with the industry average. Something you'll note when looking at the seller note statistics there is that, of course, the interest rate might look rather appealing, but do understand that the condensed repayment period has a sizable impact on free cash flow. And finally, a little more than 1 in 2 deals were fully funded at closing with those all cash deals. Next, we will talk a little bit more about down payments now that we've covered all cash transactions. So as expected, no external lending, reduced down payments. With external lending, that figure goes up a good bit. You will note that the delta between 100% on the external finance side is driven by deferred payments, typically based on purchase price contingencies. For any sellers out there concerned about taxes and timing, there are different strategies where you can either receive what would be a lump sum payment over a series of payments without recognizing constructive receipt, which is basically the IRS's way of saying, well, you had access to the funds, therefore you've received the funds, which is usually not the argument that we're looking to make. Conversely, if a seller is receiving a stream of payments over a period of time, you can recognize the taxability of the entire transaction up front by opting out of the installment sale tax treatment. So all of that is to say there is flexibility on deal structuring in terms of taxes beyond just the simple cash timing.
So simple question for you here, Parker, but I know it comes up because I've heard you say that before on phone calls about opting out of the installment sale tax treatment.
Mm-hmm.
Most of the sellers on the phone call look at you kind of cross-eyed. Why would they do that?
Right. Yeah. So really, it's like many things in business investing. It's anticipating what might be coming in the future, primarily changes to long-term capital gains tax rates, and even short-term, but realistically long-term. So anyone that might expect those to be going up, of course, we like to look at national debt and some of the measures that were utilized during the pandemic. Where does the government look to recoup some of that funding? Well, a lot of folks think that might be coming from the coffers of business owners in the form of capital gains taxes. So there are some folks out there looking to front run that and potentially offset some future increases.
All right, and one more just to throw you off your game here. So on the clawbacks, you said revenue, AUM, I think you said clients. Can you share the difference between those with the audience? Like why you might pick one versus the other? What's most common?
Sure, yeah. And I'll just start by caveating and saying that there really is no perfect mechanism in every deal that we work on, every conversation we have. We can always dream up a different circumstance that might impact the seller or the buyer conversely, but they do have their different purposes. Revenue, usually from a buyer's perspective, you've got debt on the acquisition, so you care mainly about your ability to service that debt, aka how much money is coming in. Conversely, sellers might argue, well, wait a minute, we can't control markets, we can't necessarily control investment performance, especially if you're the one behind the wheel. But we can control for client retention. Therefore, let's peg the retention or the attrition against who is still here at a certain point of time. And then there's a few others. Net asset flows is becoming more common, where it still strips the market out of the equation, but does take some more of the literal financial occurrences into account. All right. Moving right along. There we go. So financing options, speaking of, just to delve further into that, the options do continue to grow for this professional services industry. Bank financing still did lead the way in 2022, despite the rising interest rate environment. A few different reasons people choose bank financing: longer payback periods, comfort for sellers that don't want to act as lenders, lack of affiliation restrictions. So those are some of the key components there. You will notice seller financing, and that includes earnouts, continues to play a large part in the space, though times have really changed since it was the only game in town. Quick note for sellers out there entertaining seller financing: just make sure to or just understand that you will be subordinated to external financing if the transaction has a multi-sourced financing. And then finally, you'll notice there at about 1 in 8 transactions, broker dealers and RIAs continue to formalize and refine their lending programs, carving out another viable option for M&A financing. With that, next up, taxes, everyone's favorite topic. So we can dig into that a little bit further. You'll notice on the left there, what I like to call the big three: personal goodwill, consulting support, and restrictive covenants, very common tax allocations for these transactions. But beyond that, it's important to know not just the economics, but also how these can affect the enforcement of a transaction. So, consulting support and restricted covenants, you do need some amount allocated there, despite the taxation of those considerations. And really, you need that to support those either actions on the consulting side or inactions on the restrictive covenant side. Another note about taxes: it is a little miscellaneous, but I do want to bring it up just because we talk a lot about this in our financial modeling, is that the sale of professional services businesses by actively involved owners are not subject to net investment income tax. So everyone out there that's penciling in an additional 3.8% for taxes, you don't need to worry about that, thankfully. Couple less common but still incredibly important tax allocations shown to the right are the tangible assets as well as entity or equity, so shares or ownership units. Really quick on the tangibles: they're not included in every transaction, and realistically, a lot of times when they are included, it is through a side agreement, just because the taxation on those assets is not favorable for sellers. So it's usually handled in a side agreement. One common issue that we do see is folks either looking to purchase the wrong thing or sidestepping the correct transaction structure just based on taxes. And what I mean by that is instances where clients are looking to purchase an entity when it doesn't hold any real value, the ability to break a sale into a hybrid strategy, so part asset, part entity, great taxation while still acquiring the correct assets. And then finally, even when the entity is the true acquisition target, and you might look to establish basis, there are strategies where you can recognize more tax benefit early now versus later in the future when you go to sell. So that's a little bit on the tax front. Next, we can look at buyer conditions up until this point, or really rather what is to come for buyers. There we go. So seller financing increasing, and I just pause here because I know we're coming up on time. So seller financing is increasing, but we do stress that folks understand the acquisition economics when making decisions. There's a lot to do with taxation that in fact impacts the actual net take home. So we do stress that fact. Purchase price contingencies and earnouts are on the rise, but as a general note, sellers are looking to support and participate in business growth. But from a buyer's perspective, it's important not to double pay. When you're buying a business that's been growing over the long term, it is expected that some amount of growth will continue, and that does substantiate the purchase price. Nicole and Kristen mentioned tax advantage and scalable entities. Of course, we're seeing more of that on the horizon. And just a general note around market volatility is, of course, it does take time for those impacts to be felt within valuations and deal metrics. So now switching gears, we'll take a look at the other side of the coin from the seller's perspective. And again, focusing on seller financing here, something to remember is just to adequately secure that debt if you are a seller financing a deal. Another point on the screen here I want to touch on is the fact that buyers are facing headwinds from different market factors such as rates and just the general economics. So they're interested in controlling risk where they can. And one of the ways of doing that is by retaining key staff and office locations to minimize change for clients. And then finally, as we've talked about, the means and comfortability of remote acquisitions will continue to increase. Before we delve deeper into more seller insights, I'd like to first establish a basis for the types of transactions that are taking place. And what you'll see there in green in 4% is mergers. I'll talk a little bit more about that in a moment. While those only represent 4% numerically, they do collectively represent a larger proportion of business value in comparison to that 4% metric. So seeing an increase there. Open market transactions were about 1 in 5, so publicly listed and intermediated deals. Private transactions, that's about 2/3 direct business sales. And then about 1 in 8 were internal or succession plan. We do just separate those based on their nature, even though some of those transactions very closely resemble the open market. Just to elaborate on the mergers and equity swaps component, we will give you some best practices to avoid headaches down the line, as well as make sure that you have the best outcomes. So first and foremost, consider your long-term goals. Is it tax benefits, succession planning, acquisition and growth, all of the above? Do really ruminate on those, as it will help guide you down the pathway. We know that informal partnerships and teaming are very common in this space, but we would stress to avoid integrating things like accounting and operations before you've done your due diligence. We work to unwind those, and it can be quite troublesome sometimes. Another key point here is just that the benefits and synergies of mergers, when I'm talking a formal, larger scale operation combination, that takes time. We're thinking 5 years minimum there. So if your time horizon is not supportive of that, you might be looking at a different type of transaction. And with that, we've talked about what. Now let's talk a bit about when. So as far as transaction seasonality goes, we're right in line with prior years here, with the exception of Q3. Some of those transactions did pull forward into Q2 in 2022 in light of the interest rate environment. I was getting many calls, many emails with the words rate lock included, bolded, however you want to say it. So many deals were pushing forward with financing costs when they could. Beyond that, Q4 is always elevated as folks look to enter the new year with a clean slate. And then a lot of times, some of those deals spill over into Q1. So usually there's some elevation there as well. And finally, with that, we'll see what's in store for sellers in 2023. One key component is just turnkey businesses being more valuable as long distance roll-ups continue. So when I say a turnkey business, that means a fully built out operation with staff, infrastructure, etc., versus just a client list. As sellers are placing more emphasis on practice management, having more non-competition agreements in place with staff and contractors will make for more desirable acquisition targets. One thing about business values you'll see on the point there, just during times of economic expansion, it's a lot more common for a seller to simply set their price and eventually get it. But these days, pricing is more impactful. Similar to the real estate market, you don't want to price too high and sit. So that can play more of an effect. And then finally, the last point I'll make is just around the time and effort of the client transition support. So change is hard at any given time, let alone amidst challenging business conditions. So you are going to need to spend a little bit more time and effort to convince clients to kind of uproot who's taking care of them in the new buyer when there's challenging circumstances out there. So that's it for sellers on 2023. And with that, I will turn it back to David.
Wonderful. Thanks for the insights there, Parker, and everyone for sticking with us here. So we are through the core part of the presentation. You had a chance to hear from obviously Matt Matrician from AssetMark here to kick us off as a sponsor, which we obviously greatly appreciate, as well as our other sponsors. We also heard from then Nicole, Kristen, and Parker with their various perspectives. Now we get to go really into the Q&A portion, the panel discussion. I tried to weave in some of your questions throughout. We were also helping moderate those things. But for those of you that have some time, want to stick with us here, we have some good questions that were submitted that I think will serve as good talking points, collectively for the panel. So let's start with a couple of more interesting ones that were asked in a variety of different ways, but generally kind of a common thread to them. So this one's going to come to you first, Nicole. So this is from Eric M. So in the past, you authored an article related to the assignability and reasonable comp of certain commissions, compensation for advisors, and an S corp. Can you talk more about, speak to that issue around moving the money from the individual working under a BD to an entity, and more challenging, can you do it succinctly?
I will try my best. I know it's a complex topic. So if you own an entity as a single owner, the best approach is to get that revenue over by utilizing your entity as a company that provides practice management services to advisors. Typically, you would not get all of your revenue over there, maybe around 80%. If you have a team that generates the revenue, hopefully maybe a multi-owner company, 2 owners or 3, and it doesn't matter if they have a 1%, 5%, or 20% ownership. The options are a little broader. You could potentially get all of your revenue over without any compliance or IRS issues, or at least with reduced risks. But there have to be some safeguards in place that we can typically help advisors with.
Okay, got it. So totally different note, and probably I'll start with you, Parker, since I have heard you answer this question before. But Kristen, I'm gonna guess it comes up in the seller advocacy stuff, maybe even valuation, interest rates, deal values, correlated, not correlated. What are you seeing, Parker? We'll start with you.
Yeah, sure. So as always, there's a few layers to the question, but I will look to keep it succinct. In the short term, we're not seeing a material impact to deal multiples. One of the primary reasons is just because external financing, whether interest rate aside, is a little bit newer to the space as far as an option goes. So we do still think that longer term values might still be technically undervalued just because there's so much capital available. And really, a lot of these businesses are, cash flow positive from year one, putting $0 down out of pocket, and actually at a relatively favorable rate. So a lot of buyers are targeting around 20% free cash flow, net of debt, net of taxes, which many of these deals pull off quite easily. So the other component I will mention to that is just that it is a little bit dependent on sellers making concessions. So basically agreeing that, hey, interest rates are higher, therefore, it's going to be harder for you to make the acquisition. Therefore, I might concede on price. That's not a guarantee, but when those do happen, those will filter into the comparable sales that help drive valuations. Finally, the last thing I'll mention, and I did mention it before, is really understanding the economics of the acquisition from the tax perspective, and the debt service play a huge role. Some folks know straight out of the gate, but a lot of folks, when we talk to them, they really are surprised by how much net cash flow they can achieve with these acquisitions just based on the favorability of the tax.
Yeah, okay. Anything, Kristen, he missed there? Again, I've heard you speak to this same subject and question. Oh, she's our first person to talk on mute.
I would mirror a lot of that. I think that ultimately the interest rates are not having a significant impact. They're being brought up in conversations a bit more than they used to be, of course, but it's not necessarily changing the purchase price or final multiple of the acquisition. And I think a lot of that has to do with the fact that, again, as we've mentioned in historical webinars and in this webinar, practices are still somewhat undervalued, right? A practice that can sell in cash flow positive, net of debt service, net of expenses on day one is pretty darn rare. And so as much as the buyers probably don't want to hear that, that is the reality. And so the interest rates just aren't having that much of an impact, not on the multiple. I think where it could have an impact is on some of the deal structuring.
Yeah, okay. Got it. And while you are off mute, I'll ask you another one we had that came up during the multiples topic. And again, another one that comes up frequently around this subject. It is from Eric, and he wants to know, why would a firm be willing to pay anything for non-recurring revenue? What are your thoughts? Why would you pay 0.7 for some of these commissions they got last year?
Yeah, generally speaking, for a firm that is recurring revenue all day long and then they sell a one-time commissionable product, you probably wouldn't pay anything for that. And the reason behind that is because it is truly one time. However, for most firms, they tend to be operating at a 95-5 split. In other words, they're 95% recurring and 5% transactional year over year over year. And so even though that 5% is transactional, it does have a recurring underlying dynamic. And so that recurring dynamic or underlay helps substantiate that 0.7 multiple.
Yeah, okay. Got it. So the next one that was submitted was from, I'll just say this one because I know him. So Chris Emick over at Cambridge had sent this over to me ahead of time. And so I will take it since I get to be the MC. I get to talk for once. So, and you guys welcome to chime in on this one. But Chris's question was, what impact do we see PE, firms, private equity backed firms having on industry and valuations? I mean, the funny thing is, I would tell you from the seat we sit in, there's a whole bunch of talk about private equity backed firms and the crazy high values and multiples that they're paying. And then you actually sit down and you look at the transactions that were done. You're looking around, and you're trying to find a transaction that was done with one of these private equity backed firms. And you got to look really far and wide to find them. So they do happen. And I think all of the conversations around the offers that they're talking about and making, while they may not appear as good in the fine print as they did initially in their offer, the conversations and the multiples that they're talking about and proposing at the end of the day, I think they are going to help drive values up industry wide. But that said, the devil's in the details, and a lot of these offers that you hear from folks, that they got a letter that they were offering 12 times their earnings, and it's $1 million RIA with one part-time staff person that's taking $900,000 to the bottom line, thinking, well, shoot, 12 times that figure, I'll retire yesterday. Most cases, if it sounds too good to be true, it probably is. They are incredibly good at normalizing the P&L. You generally don't get all of the purchase price at closing. You'll get a lot of it in company stock, which might not be a bad thing, but devil's in the details. So bottom line, what do we see it doing for the industry? I think it will help it long-term. I think it's going to help it, more importantly, really long-term, like 5 and 10 years from now, just given all the teaming like that Nicole was talking about, and that I think Kristen and Parker, all of us collectively have observed from different perspectives, all that teaming is going to lead to a whole bunch of really big firms. Then you're going to have a harder time finding capable buyers that can afford to buy those. That's why I expect those PE firms will pop back up as a really good resource, because they're the few firms that would be able to acquire it. Anything I missed there, guys?
The only thing that I would add is one of our services is Second Look. So we often are sent, offer letters that people are receiving and provided guidance and insight in regards to those LOIs. And to David's point, I think that there is a lot in regards to the details. The devil is truly in the details, but also the devil is in the details that aren't in those LOIs. So a lot of times, taxation of a particular acquisition is very commonly omitted. And that's huge, because if you have, a $1 million practice, as David was mentioning, regardless of what multiple you're using, but the taxation is all ordinary income, right? Versus long-term capital gains tax rates. That's a huge difference in regards to your bottom line. So again, I think that truly understanding and diving into all of those details and not just focusing on the multiple, which I think so commonly just gets thrown around, but really focusing on the underlying dynamics that impact the multiple is the key component there.
Yeah. Okay. That's good insights. And I think when we talk about the private equity backed firms, a lot of times you end up thinking about these, huge roll-ups, just sending out all of these letters. But there's also, the two sponsors we have here on today's session, big OSJs, RIAs. Matt with Asset Mark was just reminding me that, and he's spot on. There's also a lot of room in between the individual acquirer who might buy one business and that's it in their entire career, which is still a pretty big accomplishment. And the private equity firms that buy, a dozen firms a year. There is definitely a trend where you'll see sellers taking some chips off the table, but they might not sell to a PE-backed firm, but they may also not just sell the entire firm and walk away. They'll sell off, 20, 30% stake in their business, take chips off the table, and then, partner with somebody like, our two amazing sponsors we have here, one with LPL and one with the advisor group. So there's some really interesting opportunities, I think, as a result of this private equity backed investments. That's just given the whole industry kind of a kick in the pants to start getting creative, which is actually a perfect segue. I appreciate you reminding me of that, Matt, to one of the questions we had from Jake here in the Q&A panel. And that is, and I'll ask this one of you, probably Parker, to start with. Do you find the simpler deals are more often accepted, or are the more complicated ones, sort of creating more incentives? What do you see? And I'm Kristen, I'm coming to you next because you deal with a lot of offers.
Yeah, sure. So that's an interesting question. I would start by saying it really depends on the personalities involved. Really, we see the full gamut. Both parties are completely aligned, just want speed, ease. They've done it before, or generally just think they know it all. Others are extremely contemplative and take a lot of time, too much time, can't make decisions, and everything in between. I will say that whether simple or more complicated, the critical factor is just understanding what the options are, what best practices are, understanding what typical pitfalls might be, and really relying on an intermediary, really what we do in the deal support service here at SRG. Again, just to highlight what's common, what you might have an issue with, other considerations to be made, as well as unintended consequences. But we see complex deals move right along, and we see simple deals meander. So it really does vary, but just knowing what the options are and what the potentials are is key.
And Kristen, your thoughts? I mean, you mentioned like the second looks. I know you see a lot of these offers. Complicated or simple? What do you think?
Yeah, I think thorough is what I would say. Having deals that are thoroughly thought out and that identify and discuss each of the components within the transaction. That can be done in a simplified manner or a complex manner, but I don't think either work if it's not done thoroughly.
Yeah. Okay. Well, for the sake of time, I'm going to hit one more here over to you, Nicole, and then we'll close things out. We got lots more questions, obviously, and we'll get back to each of you just, offline individually, just for the sake of time. So this one's from Rob O. So Nicole, if we're focused on, this is Rob, obviously, if we're focused on growing our firm, not selling, what would you recommend we think about from an organizational planning perspective? My attorney set up our corporation a few years ago, so I assume we're good. What do you think?
Good question. So if you want to grow your firm internally, Rob, first of all, I would take a look at how do you compensate employees? And usually if you want to align compensation with firm growth, you would provide something like long-term incentive plans. This is when employees start thinking and acting more like owners. Their compensation is driven by firm value. And now that I said that, the next step would be to look into what kind of entity you have set up and if it does have value. I mentioned earlier, in order for an entity to have value, you would have to contribute your goodwill. I have commonly seen agreements set up by attorneys that assume the entity has value because they don't necessarily understand how the industry is structured. So there is that extra step. It's an easy one. However, it also depends on what type of entity you have. So I would say maybe take a look at your documents, see what was set up. If you have any questions, feel free to reach out to us. But it will come down to entity structure and compensation plans.
Cool.
I would also add that Nicole's team has done a substantial amount of work in launching our annual entity program. So if you set up your entity a year or two ago, right, and have done nothing with it, you may not be appropriately set up anymore based on the standards that the IRS presents. So making sure that you're doing something annually to complete your minutes and ensure that your business is still compliant is definitely helpful.
Cool. Yep. Well, I appreciate all of you, frankly, as our amazing panelists here today. Again, I know you actually have work to get done, so we collectively appreciate it. And for all of you taking time out of your busy, I know almost end of January, as crazy as that seems, I wanted to put back up on the screen here in case anybody is curious, wants to get connected with us. Feel free to follow us on social media. We have had a couple of questions about, content from the slides here today. Our marketing team is amazing at pushing that content out, keeping you up to date on what's happening with our future events. And then I put up Nicole's calendar link just in case you want to schedule time. If you got more technical stuff, she'll obviously rope one of us in. But otherwise, we're here. We're happy to have these conversations. We'll get back to those of you who we didn't have time to get to your questions here today. But with that, we're going to sign off. Everybody, have a great 2023. Thanks.